Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Thank you to everyone that's subscribed. If you haven't done so, we greatly appreciate that. Just hit the like and subscribe button and leave a comment if there's something you want me to cover, and I'll do my best to get around to it as I have done in some of the other videos. Today we're talking about one of the holdings. I'm very excited to hold the GEO Group in Crassus Investment Fund, and we're going to go through and I'm going to give my thoughts on what I think the assets of the company are worth on their own. It's time to break out the Crassus speculation formula. Okay, it's really not a speculative bet, I wouldn't say. I think this is an asset value play, but I prefer to use the speculation formula when valuing assets as opposed to the cash flows. Just a mental line that I have in my brain. So when we look at something and we think, gee, that's undervalued, it's going through some hard times, and we don't think the value is in the cash flows it can produce to us in the future as such, but we do think that what the company owns, the assets, are very valuable, and that they're in fact valued a lot higher than what the share price is currently trading at. So we want a margin of safety always. We want to have a contrarian thesis. That's usually, well, we don't want to have it, but usually it's an inevitability that we only find these great opportunities for high upside if we take the opposite side of the equation. Otherwise, everyone is on board and they bid the price up. We want a convexity bias, okay? Think of a smile. What does that mean? So half a smile, a convexity bias, we've got a limited and defined downside, and we have a potentially exponential upside, okay? See Nassim Taleb's books, Anti-Fragile, for a better explanation. Appropriate allocation, okay? So if we find something that meets the criteria, we don't necessarily bet as heavily on these speculation formulas because there's often high degree of risk involved, and we want an exit strategy that's well defined. So we're not so much looking for a buy and hold for these types of plays. We've got a window of opportunity that's been given to us by the market, and we recognize that and we value it, and we have a strong plan as to when we'd like to enter and when we'd like to exit, because the future for the particular company might be too uncertain if we go out too far into the distance. Okay, quick facts on the company. So the revenue is expected to come in at about $2.2 billion at the end of this year, 4% top line growth over the last decade. So not bad for a company the size and the stable nature of the business. EBITDA, $439 million, 2% growth. So their margins are being slightly squeezed. That's not ideal. Market cap, just over $1 billion. Enterprise value, $3.6 billion. So that's quite a bit of debt loaded on the business. Enterprise value is market cap plus the debt minus the cash. Current share price at time of recording is $8.12. 119 million shares on issue, and a 24% short interest. Okay, I'm going to tell you why that's important in a moment. That is going to be a recipe for a gamma squeeze, I believe, and I'll talk about what that is and why it's important in the next few slides. 1.5 million in buybacks over the last 12 months. So the company believes that their price is undervaluing their assets. Return on capital is positive. Net debt to EBITDA 5.9 times. That's almost twice the amount that we would normally allow for an investment. However, the EBITDA does cover the interest by 3.5 times. That's above our debt service coverage ratio requirements, and so it means that they've likely pushed out the maturities of their debt so that they can, although they have a high amount of debt in aggregate, their monthly servicing is 3.5 times less than the EBITDA that they make, so they can continue to make their monthly requirements. Key points on the company. So they are a prison system, correctional facility, I think I'm supposed to say, whatever. First, fully integrated real estate investment trust. So they buy the land and then they construct the prisons. They go from go to woe, and then they obviously receive a fee for the operation and the renting of the facilities. They've got 123 facilities worldwide with 93,000 beds. So they're quite a big player. They're the second largest private prison company in the US. They do have a large debt load, which we mentioned. However, their current and their quick ratios are above 2. So if you take the current ratio, that's assets and liabilities due in the next 12 months, okay, they're positive. So the ratio is above 2. It needs to be at least above 1 for us to be comfortable. Above 2 gives us a little bit of breathing room and suggests that they can survive the next 12 months without a worry, or 24 months without a worry. 24% short interest and activity in the options market could equal a gamma squeeze, and I'll talk about what that is and why it's important. Higher prices trigger higher prices in that scenario. So let's take a look at what that is. What's a gamma squeeze? Where you've got a company with a high short interest, what happens is when you short a stock, you sell the stock short. So you sell stock that you don't own, and so you have to borrow it from someone else. And so you borrow the shares, sell them on the open market, and you need to pay a premium for basically renting out someone's shares and then selling them. So you pay the owner of the shares a premium. That eventually needs to be covered, okay? Now, the idea of the short sale is that you sell an overpriced security. So you borrow someone else's stock at $100 and you sell it, and you're expecting the stock to fall to $50. When it hits 50, you buy it back on the open market and give the borrower, or give the person from whom you borrowed the shares their shares back, okay? And you get to keep that difference. So $50 minus whatever the rent you had to pay that person or broker. So what happens if there's been a heap of shares sold short, and then someone comes along into the options market and purchases a heap of call options? So that, in simple parlance, is someone that's taking out a contract, betting that the shares are going to increase. Now, what you need to understand is that each options contract controls usually 100 shares. Okay, so if you buy one contract, that's controlling 100 shares. So you can get huge leverage in the options market. So if you've sold short and someone else comes in and buys a heap of options with huge leverage to start to bid up the prices, you're in trouble. You're in for a short squeeze. So as is indicated here, the call options trigger high prices and the shorts have to cover. So eventually, if you sold those shares at 100 and you sold them short, and they go to 200 to 300 to 400 to 500, eventually your broker's calling you up if you borrowed on margin and saying, hey, you hit your margin, I've bought them back for you, and you've taken a huge loss. Or you start to get further and further into negative territory, the higher that price goes. Okay, eventually you have to throw in the towel. Okay, you have to cover that short, and sometimes the more pain, or the more you wait, the longer you wait, the more pain you're going to have. So you eventually have to buy back the shares, even if it's at double the price at which you sold them, and that's now your loss. Okay. That in turn triggers high prices. Why does that happen? Because when you have to cover your shares, you have to buy them back off the open market. So you got someone coming in buying up a heap of call options, the price is rising, you go, shit, I've got to cover my shorts. You buy them, and you've got more buying activity, more demand dumped onto the market, and the prices just keep going up, which sort of forms this self-fulfilling prophecy. So GameStop was a good example. Earlier in the year, you would have seen how a group of people figured out that hedge funds had sold short GameStop. So they'd sold short more shares than were actually on issue. So their short interest would have been over 100%. So I don't know how they missed that, but anyway, they did, and they got punished for it. This gives you an idea as to how quickly this can start to move if you've got a pure gamma squeeze. So someone comes in and they buy call options. These are in minute intervals, okay? And in 3 minutes from when the peak of the options volumes on the market, look what happens to the amount of shares. It just goes through the roof, and obviously the price does as well. And then people have to start covering their shorts, and so more buyers come onto the market, and it's just a crazy scenario. So we could, let me go back, be in for that. Eventually, it would need to get a lot higher than 24%, but if the fundamentals are right, and eventually the market recognizes that, and buyers come on and start to bid up the shares, those shorts will have to cover, and that will again increase the bidding up of the price of the shares. Let's have a look at the sector. Okay, real estate is generally overpriced, or not overpriced, but expensive on a relative basis. I think it's probably the most expensive sector overall. Okay, so that's why we haven't had a real play in real estate yet. Prisons in particular are overcrowded. They've got aging infrastructure. Okay, so about a third of the buildings are over 50 years old. So things start to crack, they need replacement, depreciation on buildings as well, well worn, but you can't account for it in your tax returns by 50 years. So you need to start to upgrade your buildings. But the problem is it's difficult to get construction permits. No one really wants to have a prison in their backyard. Although if you live in Victoria, your backyard basically is a prison at the moment, thanks to COVID. And so this would be a high barrier to entry. Okay, so it's not easy for a competitor to come into the space and provide competition, thanks to the government, once again, reducing competition. Here we have $200,000 to $400,000 is the cost of construction per bed. Okay, so it's estimated that's how much per bed it's going to cost you to open up a big Fed facility. The private sector is always more efficient than the government, and so with the executive orders stating that there will be no private contracts or new private contracts during the term, obviously you've got less and less supply coming online when it comes to the prisons facilities. Prison population may be downtrending. The old Dems tend to let the Crims out. That's their voting base, I guess. But demand is still greater than supply in a lot of cases. Okay, and that's where the trend might be downtrending, but of course, if your supply is not increasing at a rate that can offset that, then you're still going to have a nice little upside. Limited competition for reasons which we just mentioned. Okay, cool. Let's have a look. So GEO Group, this is our yearly price action. So we're down 25% from this point in last year. And then if we look over 5 years, you can see we're buying it at half the price from where it was. The best way to look at GEO, I believe, is with an asset valuation. And so let me talk you through what I've done here. Let's use the cost of reconstruction. So this is a company that has 93,000 beds worldwide. What is the cost of reconstruction going to be? If you had to build that infrastructure again from scratch today, what would that cost? Let's use an average cost of 150,000 per bed. Okay, times 93,000, and we've got 13.5 billion. Okay, is our estimate. Now, obviously, if we were to liquidate the company today, you wouldn't necessarily get top dollar value for your assets, would you? So what I've done just for fun is to assume 30 cents on the dollar, and you can change the sensitivity depending on what you think the assets would be worth. That's pretty conservative, but I like to be conservative in these types of plays. So if you take 30%, okay, 30 cents on those dollars, you're left with 4.5 billion. Here we've got 1.2 billion in additional assets. Now what I've done there, I've gone through the balance sheet and just plugged it in here so you don't have to look at it, but I've taken the current assets only in their liquid form. So their cash equivalents, accounts receivable have been included, but the intangibles, like the goodwill, I have not included that because you're not going to be able to sell your goodwill. Really, it's not going to count for much if you're liquidating and performing an asset sale. So if you add back in those readily available cash assets, we get 5.73 billion as a rough estimate as to the value of the assets. Then what we've got to do to get a book value, we've got to minus the liabilities. So that one's easy. It's everything that the company owes. Okay, so the debt and their accrued expenses and so on and so forth. You take away that and you're left with 2.23 billion. To get that, so what that means is that's the asset value, the book value of the entire company. Assets minus liabilities, 2.23 billion. On a per share basis, we just take that and divide it by the number of shares on issue. And that suggests we've got an estimate for the asset value, the net asset value of $18.62. Okay, using my my valuation method there. So that's almost a triple, a double and a bit from where we are today. So that's saying that the assets themselves are worth way more than what the shares are currently trading for. Now that's all well and good, but the market has to eventually recognize that. And so the question for us is, how long is that going to take? Now we can't be sure, but if it takes you 100 years to double your money, your return is no good when you account for the time value of money. So we need to work out, or we need to get an estimate of the internal rate of return, which will give us an idea as to an annualized rate of growth of our money. So if we buy the shares today and sell for $18.62 in 3 years, we've got an IRR of roughly 31%. If it takes 7 years, we're looking at about 12.6%. Okay. And so that would still beat the market in a lot of years. Okay. So that's a very bullish case. If remember, we're just talking about the assets and not the cash flow. For fun, let's have a look at the estimates of the cash flow. They seem to be, turning around a little bit. They're not going to grow massively, but if the multiples were to revert to mean, that is interesting. So currently the company is just valued at such low multiples. What I've done is I've taken these free cash flow, EV to EBITDA, and price to earnings over the last 10 years and just taken the mean multiple and said, okay, well, if we have these projected outcomes for the free cash flow, the EBITDA on a per share basis, and the earnings, and the market reverts to mean, what is the implied price? And then what is the delta between that and today's price? So as you can see, these are the implied prices for each of the inputs, and I've equally weighted them. And we get an average expected price of $20.63. So if the market just starts to revert to mean in terms of the multiples for which it's going to pay, we're looking at a 2.5 times upside. Okay, if that takes 3 years, again, that's a 36% IRR, so really good. And 7 years, 14%, which is also, we'd be quite happy with that. Okay, so the verdict is we're going to buy the assets. Okay, there's a margin of safety. It's contrarian thesis. Remember, the market's not paying much attention to this at all, but we are. It's got a convexity bias, so we've got a limited and defined risk. We know that if the company were to go bankrupt, we know what the assets are worth, and we think we can still do okay, although it will take a while for us to get paid out on that. And we certainly have the opportunity for an outsized return. So if we can double our money in, potentially 2 to 3 years, we'll take that any day of the week. And we have an appropriate allocation. So I'm going to put in, we already own GEO. We've got about 1.2% of assets under management, and we're looking to grow that probably to 2, maybe even 3% of AUM, scaling in over the rest of the year. We'll see how we go. If the price continues to drop, we'll scale in. If it rises, then we'll just hang back and wait. Certainly got an exit strategy. So once the shares would trade at 1 times net asset value, or around that $18, then we'd look to exit. Okay, and because it's not a growing company, we're not buying it for the cash flows as such. We're really buying it because there's such a big mismatch between the asset value and the price. So once that reverts, we're out, and we'll roll that into another opportunity. Thanks for watching. If you haven't already liked and subscribed, we'd greatly appreciate you doing that. And if you're ready to rock and roll and copy the portfolio, just click on the link that I'll leave in the description. Or if you just want to check out the portfolio, add it to your watch list, by all means, be my guest. And thanks for watching. Disclaimer, as always, you're responsible for your own decisions, and I'm not a financial advisor, and you should take everything you hear with a grain of salt. Make sure that you're doing your own due diligence and really taking your own investment journey seriously, because you are responsible for your decisions, your actions, and the results that they produce. Thanks for watching. I'll be back with another episode, and hope to see you then.